Hi, my name is Fred. We're washuorange team. We're from Washington University in St. Louis, Master of Science in Quantitative Finance program. Here are our group members.
Hi, I'm Rachel.
I'm Riri.
I'm Ashwin.
I'm Tom.
Hi, I'm Victor.
And I'm Ricky.
During our competition, we used a multi-factor model to build our portfolio. And then we assign equal weights to the factors. As on February 14th, we ranked the number 7th. And today, we're very happy to give you a presentation about our investment. And then Lily is going to present investment philosophy. Thank you.
To construct our multi-factor model, we considered factors that may affect stock performance in different aspects. We first took momentum factor into consideration. According to academic research, stock that has been going up is more likely to keep going up in the future. Stock in its downturn is likely to keep going down in the future. So we filtered out all the stocks that have been in their downturn for a relatively long time. Besides the momentum factor, the model requires at least one value factor, which represents the fundamental value of the company, one growth factor, which signifies the future growth of the company, and one quality factor, which reflects the company's operating situation. We finally picked 4 factors. For value factors, we chose PE and EV/EBITDA. PE ratio is price per share divided by earnings per share. Lower PE means undervaluation of the company, and we want to invest in companies that have been undervalued. However, PE ratio ignores the level of debt on a company's balance sheet, so we introduced EV/EBITDA, which takes the debt level of the company into consideration. EV/EBITDA shows the value of the company. EV is the enterprise value. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's the earnings that are available to all stakeholders. Similar to the PE ratio, a lower EV/EBITDA represents a cheaper valuation. For growth factor, we chose dividend yield. Dividend yield is simply dividend per share divided by price per share. It is the most direct factor that can show you how much you will earn per dollar you invest. Higher dividend yield means higher return you will get. This also helps to reduce our portfolio volatility. For quality factor, we chose cash flow coverage ratio. It's operating cash flow divided by debt. This factor indicates the company's ability to carry debt. Higher the ratio, better its ability to carry debt. Right now, companies are issuing large amount of debt to buy back stocks or acquire other firms, which can be a big potential risk. We want to invest in companies that can pay back this large amount of debt to avoid such risks. We constructed the model with these 4 factors, looking for stocks that have market undervaluation, high dividend yield, and good quality operation, which will assure better performance than the benchmark. Now let's move to the portfolio construction and trading part of our investment.
After we pitched our stocks based on the scores calculated through using various factors, we optimized our portfolio weights by trying to maximize risk-adjusted return, as well as maintaining market-neutral property of our portfolio. In the process of portfolio construction, we used Sharpe ratio as one of our measurements to risk-adjusted return, and we set the limit to the position of each individual stock to ensure diversification. The position of each individual stock is limited to 5% to 18%. Besides, the cash at hand was also restrictively limited to under 5%. After we set our objective and imposed constraints, we used Bloomberg Optimizer to find out our optimal solution and formed long position and short position respectively. In the end, we scale up the weight of short position to make portfolio beta close to 0, so that our portfolio is market neutral.
Now I'm going to talk about risk and return expectations. One major risk of our portfolio is market risk, because although we constructed a zero beta portfolio, it is not well diversified in terms of industries. The consumer staples and consumer discretionary took up 23% and minus 30%. If these sectors move in unfavorable directions in response to market events, our portfolio will suffer a great loss. Another big risk is that the undervalued stocks we long and the overvalued stocks we short may not converge to our expected price during the competition period. When constructing the portfolio, we expect it to outperform the S&P 500. According to past data, we expect the annual return and risk of S&P 500 to be 6.95% and 13.42% with a Sharpe ratio of 0.35. We used Bloomberg to conduct a backtest on our portfolio, and we expected an annual return and risk to be 8.22% and 12.52%. This yields a Sharpe ratio of 0.48, higher than the S&P 500 Sharpe ratio. We also estimated our value at risk to be roughly $208,000. Now I will hand over to Ashwin to talk about the actual portfolio performance.
Thank you, Lee. Let us now look at our portfolio performance. During the first few weeks, our returns were quite different from our expectations. In fact, we were having negative returns until the first half of December. To point out, during December 7th, we had a negative return of around 6% with an alpha of just 1.05%. This is when we got together to discuss on rebalancing our portfolio. After hours of discussion, we decided to believe in our original model and go with its initial choice of stocks. This is pretty much like believing in Tom Brady in Super Bowl 51, and sure enough, it paid off. Our returns were increasing. On December 28th, we reached 0% return and the upward rally continued. As on February 12th, we have a return of 4.66%, also an alpha of 5%, and a beta of 0.08, which is very close to our goal of 0 beta. Next, Ricky is going to talk about the portfolio attribution.
Thank you, Ashwin. Now, about our portfolio attribution. The main driver of our portfolio return is our choice of factors. We believe our multi-factor model can ultimately generate a positive alpha despite short-term market fluctuations. The reality proved our investment philosophy. Although our portfolio suffered substantial losses due to political uncertainty at the end of 2016, our portfolio has achieved a 5.01% return up to 13th February 2017. After the new year, market starts to properly absorb the political and economic impact of the new administration, and stock prices start to converge to fundamentals. There are two major reasons that limited our performance. First, several short positions in healthcare company and industrial good company incurred substantial losses. Second, we didn't clear our losing positions because we expected their return converged to fundamentals. However, apparently there are some outliers that we should get rid of earlier. With all that said, we stay positive about our investment model and portfolio allocation. The further return to fundamental value will continue to generate a positive alpha for our investment. Thank you.
Lastly, we thank CQA for this great opportunity. We had a wonderful learning experience. Thank you.